So this is a very large credit facility or bridge facility for this deal, $59 billion. It's large, but Netflix is a very strong credit,
Yeah.
right? Netflix is a company you would want to lend money to. So Netflix has single A credit ratings, a very, very low leverage ratio, it's growing EBITDA, significant free cash flow. So Netflix is a very strong company, a very good borrower. So it's not surprising that banks would line up to lend them money.
Steve, eventually this bridge facility is going to be termed out. They're going to come to your market. They're going to come to the corporate bond market, Steve. Talk to us about kind of your market today and deals of this size.
Yeah, so we have seen some very big deals in the past, and this is a big one. But the investment grade bond market is very deep. I'm sure they may also hit the loan market too. So
Yeah.
there'll be different options that they'll have out there for financing this. But this is a big deal. But again, this is a very strong credit. Netflix bonds are kind of scarce. So if you think about the big communications companies, there's tons of AT&T bonds, there's tons of Comcast bonds,
Right.
tons of Verizon, T-Mobile. There's not that many Netflix bonds out there, so there should be a lot of room for investors to bring on some more Netflix bonds.
I mean, you could argue, Steve, that from a financing perspective, this is probably the safest deal Warner Brothers Discovery could have done because, again, your market, I would think, as you mentioned, is just going to sop up whatever they want to bring to the debt market.
Oh, yeah. So if you thought about some of the other potential buyers out there, yes, they would have had more difficult time financing that. They could get it done, but it would not be as easy as it will be for Netflix, given, again, the strength of Netflix's credit profile. Not only does it not have that much debt, its growth rate is very strong, right? So when you think about the EBITDA growth rate going forward, it's going to delever pretty quickly. And plus, it generates a significant amount of free cash flow. I think Netflix said that they're committed on the call just before that they're committed to their investment grade ratings, and within a couple of years of closing the deal, they'll get their leverage back down to a level that is consistent with their single A ratings.
We continue with Stephen Flynn here, expert on credit with Bloomberg Intelligence. Stephen, I got 8 ways to go here. I want to get you on next week when the dust settles down here a little bit. You're at Lehigh University. You're the only one who passed Modigliani and Merton. What debt level can Netflix comfortably gross out to? They don't want to go out to 40% debt on a balance sheet. They can go from what? 3 to 9%, and it's like a rounding error, right?
Exactly. First of all, when you look at the total enterprise value of Netflix, their equity market cap is very, very large. So their debt to total capital is a very small number. They've always had a very small number. So they have plenty of flexibility. Leverage ratio, right? Like their leverage ratio is not even a half a turn. I think as of the last quarter, it was like 0.4 times. So they could go up to a couple of turns easily, right? You think about their peers with single A credit ratings. You have Comcast has about a 2.3 times net leverage ratio.
Right.
Disney's just about 2 times, a little over 2 times. So there's plenty of flexibility from where Netflix is now to where their peers are. So they have plenty of room.
Okay, I got to squeeze this in because Sweeney wants to know for the 10 a.m. show. It's as simple as this. They got to spin off the dogs. Do they dump the debt on CNN, TNT, and Discovery, Animal Planet, and the rest? And how much debt do they dump in? How does that mechanism work, Stephen Flynn?
Yeah, so we're going to work through all the details of that, but it looks like that they are going to keep about $10 billion of debt onto the studios and streaming. So there will be a lot of debt on global linear networks.
Will they get rid of CNN? I mean, this guy in Delaware keeps emailing me. It's a pain. But, what do? They sell it off, right, Stephen?
See, I'm not sure exactly what they'll do with CNN. I don't think they've commented yet.
But the point is this new SpinCo coming out of Warner Brothers Discovery, that's going to carry a lot of the debt. But those things have a lot of cash flow, right?
Yeah. So the leverage ratio won't be that high, and the cash flow is good. It's just a question of how long does it last, right? These are businesses that are under significant stress, that are under a lot of pressure. So the question is, how long will that cash flow last?
Stephen, are you going to work next week, or is this like your last day of the year?
He's a credit analyst. They always work.
That's a great idea. No, unfortunately,
you're coming on next week.
Not that many T days left.
Listen to the 6 phone calls left, and we'll get Stephen Flynn on next week. Really at the heart of the matter, which is, as Paul's led on all morning, the banking transaction. Paul, the bridge loan of a $80 billion deal is $50-some billion.
It's going to be, it's just going to be massive. And again, 3 banks are going to underwrite this. They'll syndicate it out to a lot of other banks, but it's a huge number. But as Steve Flynn said, the market's ready for it.